Banks are using $6 trillion in liquidity to control Bitcoin. Not to buy it, not to destroy it, to control its volatility. And if you think banks don't care about Bitcoin, or Bitcoin is too decentralized to control, let me show you 3 pieces of publicly available data that prove banks are actively managing Bitcoin's relationship with global liquidity. Fact 1, according to Federal Reserve data, the reverse repo facility peaked at $2,553 trillion in December 2022, then declined to approximately $300 billion by late 2024, while Bitcoin rose from $1,600 to over $70,000 in the same period. Fact 2, according to research from Fidelity Digital Assets published in 2023, Bitcoin shows statistically significant correlation with global M2 money supply changes, with correlation coefficients exceeding 0.80 over multi-year periods. Fact 3, according to Bank for International Settlements data, approximately $6 trillion in dollar liquidity sits in Federal Reserve facilities, bank reserves, and money market funds. And movements in this liquidity consistently precede Bitcoin price changes by 2 to 4 weeks, all verifiable, all documented in public sources, all pointing to the same conclusion. Banks control massive amounts of liquidity sitting in Federal Reserve facilities. And when this liquidity moves, even slightly as Bitcoin responds dramatically, not because banks are trading Bitcoin directly, but because Bitcoin has become the most sensitive detector of global dollar liquidity conditions, a 24/7, globally traded canary in the liquidity coal mine. By the end of this video, you'll understand exactly how banks use liquidity positioning to influence Bitcoin, why this mechanism is getting stronger, not weaker, and how to track this relationship yourself using free, publicly available data. Because there's a 3-stage mechanism that's been documented across multiple market cycles. Stage 1, banks park liquidity in Federal Reserve facilities, removing dollars from circulation. Stage 2, banks deploy liquidity from Fed facilities into markets, activating dormant dollars. Stage 3, Bitcoin responds first and most dramatically to liquidity changes, 3 to 5x more than traditional assets. This pattern played out identically in 2019-2020 and again in 2022-2024. Same mechanism, same institutions, same result, and it's accelerating. Stick with me because the next 15 minutes will show you how to track this mechanism in real time using data anyone can access. Let me start by explaining what the $6 trillion actually is. The $6 trillion liquidity arsenal. When I say banks control $6 trillion in liquidity, I'm referring to specific measurable pools of dollars, not speculation, not estimates, exact amounts published weekly by the Federal Reserve and other institutions. Pool 1, Federal Reserve Reverse Repo Facility. According to Federal Reserve data published daily at newyorkfed.org, the Reverse Repo Facility, RRP, allows banks and money market funds to park cash at the Fed overnight. They deposit dollars, receive a fixed interest rate, historically 0 to 5%, depending on Fed policy. Get their cash back the next business day, zero risk, complete liquidity. According to the Fed's own data, which you can download yourself, the RRP balance has ranged from $0 in early 2021, barely used, to $2.553 trillion peak on December 30th, 2022, to approximately $400 billion by late 2024. That peak $2.5+ trillion represents dollars removed from circulation, not buying stocks, not buying bonds, not buying Bitcoin, just parked at the Fed earning safe interest. Pool 2, bank reserves at the Federal Reserve. According to Federal Reserve H3 data published weekly, commercial banks are required to hold reserves at the Fed, but they hold far more than required. These excess reserves represent liquidity banks could deploy but choose not to. According to Fed data through 2024, bank reserves peaked at approximately $4.2 trillion in 2022, remained elevated at $3.5 trillion through 2024. Required reserves are only about $200 billion, meaning $3+ trillion in excess reserves. That's liquidity banks are choosing to hold rather than lend or invest. Pool 3, money market fund assets. According to Investment Company Institute data published weekly at ICI.org, money market funds hold cash for institutional and retail investors. These funds invest in treasury bills, commercial paper, repo agreements, bank deposits, all very short-term, very safe. According to ICI data, money market fund assets exceeded $6 trillion by 2024, up from $4 trillion in 2020. $2 trillion increase in cash sitting in money market funds. Total, approximately $6 trillion, RRP, 0.4 trillion as of late 2024. Bank reserves, 3.3 to 3.5 trillion. Money market funds, $6+ trillion. There's overlap. Money market funds use RRP, so you can't simply add them. But the order of magnitude is $6 trillion in liquid dollar assets that could flow into markets but are currently in safe, liquid positions. This is the arsenal, the ammunition, the liquidity that banks control. Now let me show you how it affects Bitcoin. The mechanism, how liquidity movements control Bitcoin. The mechanism works through 3 stages that have been documented in multiple market cycles. Stage 1, liquidity parking, dollar drain. When banks and money market funds park cash at the Fed, those dollars are removed from circulation. According to Federal Reserve flow of funds data, when $1 trillion moves into RRP, that's $1 trillion not available for purchasing securities, making loans, investing in assets, creating credit. The money effectively disappears from markets. It still exists, but it's frozen at the Fed, not circulating. Historical example, according to Fed data from 2022, RRP went from $1.6 trillion in March 2022 to $2.3 trillion by June 2022. That's $700 billion parked in 3 months. What happened to Bitcoin during this period? According to historical price data from CoinGecko, Bitcoin fell from $47,000 in March to $20,000 by June, a 57% decline, while $700 billion was being parked. Correlation, liquidity drain, mock Bitcoin falls. Stage 2, liquidity deployment, dollar activation. When banks and money market funds withdraw cash from the Fed, those dollars re-enter circulation. According to the same Fed data, when RRP declines, that cash must go somewhere. Treasury bill purchases, yields attractive. Risk asset purchases, stocks, bonds. Credit creation, loans. The money activates, starts circulating again, creates buying pressure. Historical example, according to Fed data from 2023-2024, RRP declined from $2.4 trillion in January 2023 to approximately $400 billion by late 2024. That's $2 trillion deployed over 22 months. What happened to Bitcoin? According to historical price data, Bitcoin rose from $1,600 in January 2023 to over $73,000 by March 2024, a 342% gain, while $2 trillion was being deployed. Correlation, liquidity activation, treasuries, Bitcoin rises. Stage 3, Bitcoin's amplified response. Why does Bitcoin respond more dramatically than other assets? According to academic research and institutional analysis, reason 1, no market hours. Bitcoin trades 24/7, 365. According to data from cryptocurrency exchanges, Bitcoin has continuous price discovery. No opening bell, no closing bell, no weekends. When liquidity shifts, Bitcoin can respond immediately. Stocks must wait for market open. Bonds trade primarily during business hours. Bitcoin absorbs liquidity changes in real time. Reason 2, global and permissionless. Bitcoin trades on hundreds of exchanges globally. According to CoinMarketCap data, Bitcoin has liquidity in United States, Coinbase, Kraken, Europe, Bitstamp, Bitfinex, Asia, Binance, OKX, Latin America, Middle East. Anyone, anywhere can access liquidity. No brokerage account needed, no minimum balances, no accreditation requirements. This means liquidity can flow into Bitcoin faster than traditional assets. Reason 3, pure liquidity sensitivity. Stocks have earnings to analyze, bonds have interest payments, commodities have industrial supply demand. Bitcoin has nothing fundamental except scarcity and liquidity. According to research from Fidelity Digital Assets, 2023, Bitcoin's price is primarily driven by liquidity conditions, 80% plus of variance. Sentiment, narrative, remainder, not earnings, not cash flows, not industrial use, just liquidity and belief. This makes Bitcoin extremely sensitive to liquidity changes. Reason 4, high volatility multiplier. According to historical volatility data from Bloomberg, Bitcoin's annualized volatility, 60-80%. S&P 500's annualized volatility, 15 to 20%. Gold's annualized volatility, 12 or 15%. Bitcoin moves 3-5x more than traditional assets for the same liquidity shock. This amplification makes Bitcoin the most visible indicator of liquidity conditions. Documented historical evidence. Let me show you the 2 most dramatic examples with exact, verifiable data. Case Study 1, 2019-2020 Liquidity Expansion. Stage 1, September 2019. According to Federal Reserve data, Repo markets seized up in September 2019. Overnight, repo rates spiked from 2% to 10% on September 17, 2019. This is documented in Federal Reserve Bank of New York press releases from that period. The Fed responded with emergency repo operations. According to Fed data, Fed balance sheet began expanding from $3.76 trillion in August 2019, reached $4.24 trillion by March 2020, pre-COVID. That's $480 billion in expansion before anyone knew about COVID. Stage 2, October 2019, February 2020. According to historical price data, Bitcoin was $8,300 in September 2019, rose to $2,400 by February 2020. That's 25% gain. During the same period, S&P 500 rose only 8%. Gold rose 7%. Bitcoin moved 3x more than traditional assets. Responding to the liquidity injection that was happening quietly. Stage 3, March 2020, December 2020. COVID hit, Fed went into full crisis mode. According to Fed data, balance sheet exploded from 4.2T to 7.4T, 3.2 trillion under 9 months. According to price data, Bitcoin went from $5,000, COVID crash, to $29,000 by December, 480% gain in 9 months. S&P 500 gained 68% same period. Gold gained 16%. Bitcoin amplified the liquidity injection by 7x compared to stocks. Case study 2. 2022-2024 RRP drain. This is the most dramatic documented case. Stage 1, December 2022. According to Federal Reserve data available at newyorkfed.org, RRP balance peaked at $2.553 trillion on December 30th, 2022. This was the high watermark, $2.5+ trillion parked at the Fed, removed from circulation. According to price data from that date, Bitcoin was $16,500. Stage 2, January 2023, March 2024. According to Fed data tracking RRP daily, the facility drained continuously. January 2023, 2.4T, April 2023, 2.2T, July 2023, 1.9T, October 2023, 1.3T, January 2024, 0.5T, March 2024, 0.4T. That's $2.1 trillion deployed from RRP into markets in 15 months. According to Bitcoin price data for the same period, January 2023, $16,500, April 2023, $28,000, plus 70%, July 2023, $30,000, plus 82%, October 2023, $27,000, 64%, January 2024, $42,000, so 155%, March 2024, $73,000, for 342%. The correlation is striking. As $2.1 trillion drain from RRP, Bitcoin rose 342%. Stage 3, the data speaks for itself. According to this documented, publicly verifiable data, every $100 billion drained from RRP corresponded to approximately $1,600 increase in Bitcoin price. This is not speculation. This is historical correlation from public data. Why banks care? You might ask, why would banks care about Bitcoin's response to liquidity? Several documented reasons. Reason 1. Derivative exposure. According to CME Group data publicly available at cmegroup.com, CME Bitcoin futures open interest regularly exceeds $10 to $15 billion notional. Options open interest adds billions more. Banks are counterparties to many of these trades. According to CFTC commitment of traders data, dealer intermediary positions in Bitcoin futures are substantial. Banks have direct exposure to Bitcoin volatility through derivatives. Reason 2. Custody and service revenue. According to public announcements, Coinbase Custody holds billions in institutional Bitcoin. Fidelity Digital Assets provides custody services. BNY Mellon announced crypto custody in 2021. State Street exploring services. Banks earn fees from custody services, trading services, settlement services, prime brokerage. Bitcoin volatility affects their business lines. Reason 3. Systemic risk monitoring. According to BIS Working Papers, 2023, central banks now monitor crypto markets for systemic risk signals. Bitcoin is large enough, 300B1T Plus's market cap, to potentially affect wealth effects, collateral values, margin systems, payment systems. Banks monitor and manage this risk. Reason 4. Regulatory requirements. According to Basel Committee Guidance 2023, banks holding crypto must apply risk weights. Bitcoin volatility effects, capital requirements, risk-weighted assets, regulatory ratios. Banks have incentive to understand and potentially influence Bitcoin volatility. How to track this yourself. The beauty of this mechanism is that all data is public and free. Here's exactly how to track it. Step 1, monitor RRP weekly. Go to newyorkfed.org, search for reverse repo operations, data published every business day, download the daily balance, track the trend. When RRP is rising, liquidity draining, bearish for Bitcoin. When RRP is falling, liquidity deploying, bullish for Bitcoin. Step 2, check Fed balance sheet weekly. Go to federalreserve.gov, search for H481 factors affecting reserve balances, published every Thursday at 4:30 p.m. ET. Look at total assets, Fed balance sheet size, securities held outright, QE holdings, repo operations, short-term liquidity. When balance sheet expands, liquidity increasing, bullish. When balance sheet contracts, liquidity decreasing, bearish. Step 3, track bank reserves. Same H4.1 report. Look at reserve balances with Federal Reserve banks. High reserves, 3T+, lots of dry powder available. Declining reserves, liquidity being deployed. Step 4, watch money market funds. Go to ICI.org, Investment Company Institute, weekly money market fund asset data, published every Thursday, rising assets, cash building up, falling assets, cash deploying to markets. Step 5, calculate correlation. Download RRP daily data, Fed website. Bitcoin price data, CoinGecko, CoinMarketCap. Import to Excel or Google Sheets. Use Coral function. On Coral, RRP range, Bitcoin range. You'll see correlations of 0.7 to 0.9. Negative because RRP rising, Bitcoin falling, RRP falling, Bitcoin rising. Step 6, monitor rate of change. Don't just watch levels, watch rate of change. 100B RRP drain in 1 week is more significant than 100 beat over 2 months. Faster changes create stronger Bitcoin reactions. Step 7, combine with other signals. Liquidity isn't everything. Also watch regulatory news, adoption trends, network activity, but liquidity is the primary driver. Understand liquidity first. Everything else is secondary. Current state of the mechanism. As of the most recent verifiable data from late 2024, RP balance, 300 for some 400 billion. According to Fed data, down from 2.5 T peak, $2+ trillion already deployed, most of the dry powder from RRP already used. Bank reserves, 3.5 trillion. According to Fed data, stable at elevated levels. Excess reserves of $3+ trillion still available. Potential future liquidity source. Money market funds, $6+ trillion. According to ICI data, continuing to grow. Another potential liquidity source if these funds shift into risk assets. Implication? The RRP liquidity source is nearly exhausted. Bitcoin's 342% rally from RRP, drain largely complete. For further Bitcoin gains from liquidity, need Fed balance sheet expansion, new QE. Bank reserves deployment, banks lending more. Money market fund rotation into risk assets. New liquidity sources needed to sustain rally. What you can do? 7 actions. 1. Start tracking RRP yourself. Bookmark newyorkfed.org. Check weekly, understand the trend. 2. Download historical data. Compare RRP to Bitcoin prices. See the correlation yourself. Don't take my word for it. 3. Set up alerts. When RRP changes by 50B+ in a week, that's significant. Bitcoin will react. 4. Don't fight the liquidity. When liquidity is expanding, be long Bitcoin. When contracting, reduce exposure. Align with the dominant force. 5. Understand the lag. Liquidity changes take 2 to 4 weeks to fully reflect in Bitcoin price. Early movers have advantage. 6. Track all 3 pools. RRP, bank reserves, money market funds, all 3 matter. 7. Combine with fundamentals. Liquidity drives price. But also watch. Adoption metrics, network growth, regulatory clarity, best trades combine liquidity plus fundamentals. Subscribe because the next video reveals which other assets follow the same liquidity pattern. I'll show you the correlation rankings, verified data, which assets lead and lag Bitcoin, how to build a portfolio around liquidity signals, all with publicly available data you can verify yourself. Final summary. Banks control approximately $6 trillion in liquid dollar assets. Federal Reserve reverse repo facility, bank reserves at the Fed, money market fund assets. When this liquidity moves, Bitcoin responds dramatically, 3x multiplier compared to traditional assets. Documented in 2019-2020 cycle, documented in 2022-2024 cycle. The mechanism is liquidity parks at Fed, dollars drain, Bitcoin falls. Liquidity deploys from Fed, dollars activate, Bitcoin rises. Historical evidence is overwhelming. $2.1 trillion RP drain 2022-2024 shears Bitcoin plus 342%. $3.2 trillion Fed expansion 2020 chunks of Bitcoin plus 480%. Correlation coefficients of 0.7, 0.9. All verifiable with public data from Federal Reserve, federalreserve.gov, Federal Reserve Bank of New York, newarkfed.org, Investment Company Institute, ICI.org, CME Group, cmegroup.com. Banks don't control Bitcoin's protocol, but they control something equally powerful, the liquidity that flows into it. The mechanism is documented, the data is public, the pattern is consistent. The question is whether you're tracking it or trading blind. The smart money follows liquidity, positions before the crowd, profits from the mechanism. Are you smart money or are you the liquidity? Thanks for watching. And remember, banks don't need to buy Bitcoin to control it. They just need to control the liquidity. And they do. $6 trillion worth.